Welcome to the Deep Dive. Today we're getting into AWL Agri Business Ltd's Q1 FY26 results. And honestly, there's this really interesting puzzle right from the start. You've got this company hitting its highest ever Q1 revenue. We're talking over 17,000 crores, right? Up 21% year over year. Solid.
Yeah, big numbers.
But then, and this is the head scratcher, their overall sales volumes actually went down by 5%.
Right.
So how do you pull in way more cash while selling less stuff? That's kind of the mystery we want to explore for you today.
Exactly. And that paradox, that's really what makes this a fascinating deep dive. It just shows you that complex dance between, internal company moves and what's happening out there in the market.
For sure.
So to figure out the why behind these numbers, we've looked at AWL's Q1 earnings call, their press releases, the investor decks, all the key stuff.
Right.
Our mission here is pretty simple. Pull out the really important insights so you can get a clear handle on what's actually driving things.
Okay, so let's start with the big picture first. The overall financials. Even with that volume dip, 1.58 million tons, they had that amazing revenue growth. What else are the core numbers telling us about the quarter?
Well, okay. Let's look at profit after tax, the consolidated payee. That came in around 238 crores, and operating EBITDA was about 519 crores.
Okay.
Now, yeah, those are down compared to last year. But the company makes a fair point. They're comparing against a high base year in Q1 FY25.
Ah, right. Context matters.
Exactly. That previous year apparently had this really favorable commodity cycle. But look, what's maybe more telling is their normalized EBITDA for the last 12 months, the LTM ending June 2025. That stood strong at 2,384 crores. So on that rolling basis, they're actually nearing their all-time high profits.
Interesting. So operationally.
Yeah, operationally, things look pretty consistent. Gross profit per ton was over 11,000 rupees, and EBITDA per ton was 3,623. It suggests they're still delivering well on the operations side despite the market wobbles.
That LPM figure does paint a different picture, yeah. But they still called it a challenging quarter. They mentioned things like muted consumer demand, some strategic consolidation in rice, and that one-off G2G rice business last year messing up the comparison.
Right.
So what specifically made it so tough, and what does this tell us about their sort of underlying health?
Okay, let's zoom right into edible oils, because this is where I think a big piece of that initial puzzle clicks into place.
Absolutely.
This segment is huge for them, right? 61% of their volume, and its revenue just jumped 26% year over year, over 13,400 crores, even though the volume fell 4%. How does that happen?
Well, the main thing really was the cost of raw materials. In Q1, those prices were like 30% higher than the same time last year.
Wow, 30%.
Yeah, so that directly pushed up their selling prices, boosting revenue. But the flip side, that led to muted consumer demand. People just bought less because it cost more.
Makes sense. And it also caused trade destocking. Retailers, distributors, they held back on orders, reducing their inventory, probably waiting for prices to settle. That hits volume.
Okay.
But here's a key shift for AWL, especially since they're the biggest palm oil importer in India.
Right.
By the end of the quarter, palm oil prices finally dropped below soybean and sunflower. That's pretty significant. It changes their cost base, potentially helping margins down the line.
Okay, so a potential tailwind there. And I saw something about a policy change, too. Sounded like it could be a pretty big deal for them.
Oh, absolutely. Huge policy shift on May 31st, 2025. The government cut the import duty on crude edible oils by 11%.
Okay.
But, and this is key, they made no cut in the duty for refined edible oil.
Ah, I see. So what does that do?
Well, it dramatically widens the duty difference between crude and refined. It went from maybe 7-8% up to like 19.25%. So suddenly, it's much less attractive to import already refined oil from SAARC countries or elsewhere. The policy is clearly meant to help domestic refiners, like AWL, by boosting their sales and discouraging those refined imports.
Right, level the playing field a bit for local players.
Exactly. Now, AWL did see a small dip in market share in oils, about 0.5% overall, a bit more in palm specifically. But management sounds pretty optimistic. They think with palm prices coming back to normal and this new policy support, they're expecting, quote, strong growth momentum ahead.
Okay, let's switch gears then. Food and FMCG. Here, the story looks different on the surface. Revenue down 8% year over year, volume down a hefty 20%. That sounds not great.
It does initially.
But the reports kept mentioning this excluding G2G rice business caveat. Can you unpack that? What's the deal there?
Yeah, that context is absolutely critical. You see, last year, AWL had this one-off deal, a government-to-government or G2G rice contract.
Oh,
It was unique, not part of their regular business, and it brought in about 316 crores in FY25. So if you pull that specific non-recurring business out of the numbers,
right.
the segment's revenue actually went up by 4% year over year. And that big volume drop, it becomes, well, almost flat, just 2% negative.
Okay, so that G2G thing really skewed the comparison.
Got it. So stripping that out, it looks much better. What else was going on in food and FMCG? I think you mentioned some strategic moves in rice.
Exactly. They did what they called a strategic consolidation of regional rice operations. Basically, they cleaned things up.
How so?
They rationalized product offerings, meaning they probably cut some less profitable rice types, and they reduced the number of lease units they were using, especially where they were just, trading non-basmati rice without much value add.
So focusing on profit over just volume.
Precisely. They wanted better profitability, even if it meant a temporary hit to the overall segment volume. And it seemed to work where it counted their branded basmati volumes actually grew in double digits.
Oh, nice.
Yeah.
Better than the market. Yeah, the overall rice industry grew about 7.8% in Q1, so double digits is strong. Their rice market share hit 8.4% by June. And it wasn't just rice.
No.
Other categories did well too. Things like pulses and besan, soya nuggets, sugar, and poha, they all kept up high-teen percentage increases in volume. And the payoff, they hit the best ever PBT, profit before tax, in Q1 for food and FMCG, 75 crores with a 5.3% margin. It really shows that shift towards profitable growth.
That's a clear strategic win then. And wasn't there an acquisition boosting this segment too, GD Foods?
Yes, absolutely. The GD Foods acquisition, the Tops brand, is already chipping in nicely. It added about 96 crores in revenue in Q1, which itself was up 9% year over year compared to Tops standalone before.
And profitably.
Yep, showing healthy profit already. Gross margins are really strong, like 52%, and EBITDA margins around 11%.
Good integration then.
It seems so. They mentioned specific actions like rationalization of manpower, putting in strong controls and processes, and importantly, plugging Tops into AWL's own distribution network and bundling it with their Fortune products. That leverage seems key.
Okay, so we've got edible oils navigating price and policy, and food and FMCG consolidating and growing profitably, especially with the Tops. What about the other part, industry essentials, and just generally, how are they expanding their reach?
Right, industry essentials. That part saw pretty decent growth too. Volume up 6% year over year, and revenue up 12% to about 2,230 crores.
What drove that?
Mostly the de-oiled cake business, apparently. Other parts like oleochemicals and castor oil derivatives, their volumes were pretty much flat.
Why is that?
They're basically running at near full utilization of capacity. Can't make much more without expanding. But even so, the segment delivered its highest profits in the last 12 quarters, PBT of 100 crores. So, good performance there too.
And getting products to market. The broader reach.
Yeah, they're really pushing on what they call alternate channels. That whole area grew by 12%. And check this out. Quick commerce, the super fast online delivery, that grew by a staggering 73% in Q1. 73%. And 79% if you look at the last 12 months.
Wow, that's explosive, bro.
It really is. That channel alone is now bringing in over 3,900 crores in revenue on an LTM basis. Shows you how important digital and speed are now. And also, their branded exports grew 22% year over year, crossing 300 crores in revenue. So international push too.
That's huge, especially the quick commerce part. What about their sort of traditional physical reach? Boots on the ground and tech.
They're expanding there too, significantly. Direct retail reach is up 18% year over year. They now reach 8.7 lakh outlets. That's 870,000 stores.
Okay.
And maybe even more impressive is the rural push. They've increased their rural town coverage tenfold since FY22, now reaching 55,000 towns.
Tenfold.
Yeah, really going deeper. Operationally, they're merging their oil and food distribution teams in cities to be more efficient. And tech-wise, they said 100% of their salespeople now use SFA software, Salesforce automation.
For better tracking and efficiency, I guess.
Exactly. And they're rolling out auto-replenishment systems, trying to use tech to keep shelves stocked automatically. Oh, and just a side note, they expect their Bangladesh business to be pretty stable over the next year.
Okay, so lots of moving parts, strategic investments, channel growth. How does this all stack up financially? What's the overall health look like, and what are the big investment plans going forward?
Well, let's look at ROCE, return on capital employed. Company-wide, it's sitting at about 11.52%.
And broken down by segment.
Edible oil ROC is looking good, consistently improving, now up to 18%. That shows its maturity.
Right.
Food and FMCG, though, that's still very much in the investment and growth phase. Its ROCE is lower, around 2%, but they have a long-term target of getting that up to 20-25% plus as it matures.
Makes sense for a growing segment. And CapEx, spending plans.
They're planning around 500 to 600 crores a year in capital expenditure. That includes about 100 crores just for regular maintenance.
Okay, any big projects?
Yeah. Their new Gohana plant is now operational. That adds a hefty 200,000 tons of basmati rice processing capacity. And they've got plants underway for Kadi pulses and Bisan and also for Mundra castor derivatives. So capacity is growing.
Got it. I think I saw employee costs jumped quite a bit.
Yeah, up 26% year over year. But they explain that's mainly because they've now fully consolidated the GD Foods employees after the acquisition.
Okay, acquisition effect. And there was something about a derivative gain.
Right. A one-off gain of about 150 crores in other income. It came from the settlement of hedges. They stressed this isn't anything unusual, it's just part of their normal hedging strategy to manage risks from commodity price swings. Sometimes those hedges result in gains when settled.
Okay, standard practice then. So finally, let's zoom out a bit. How does all this fit into the bigger picture of sustainability? What are they doing there, and are they getting noticed for it?
They seem to be putting quite a bit of focus on ESG, environmental, social governance. They highlighted some significant savings in Q1 alone, like 6% less steam used, 1.5% less power, over 11% less water.
Tangible savings.
Yeah, and they planted nearly 2 lakh trees, 190,000 just in the quarter. They're also using renewable energy in 16 locations now, about 10 milliW, which covers 11% of their total needs.
And water.
Big focus there, too. They have 11 zero liquid discharge systems, ZLD. That means they treat and reuse all the water, not discharging any liquid waste. Those systems can handle over 3,000 kiloliters a day.
ZLD is pretty advanced stuff.
It is, and they're looking at green logistics, too. About 22% of their goods are moved using multimodal transport, like rail and road combined, which is usually greener. And 10% of their transport uses green fuel, specifically PNG, piped natural gas.
Did that get recognized?
Apparently, yeah. They mentioned getting green points from the railway for using cleaner fuel for freight. And all this is adding up to market recognition. Well, a recent Nielsen report for Q4 FY25 ranked AWL as the 8th largest player in India's FMCG sector by market share. And among the top 10, they were 2nd in value growth and 6th in volume growth.
Pretty solid rankings.
Yeah. And maybe importantly for the ESG focus, they've been included in the FTSE Good Index series, which specifically tracks companies with strong sustainability practices.
So wrapping this up, what does this deep dive really mean for you, the listener? It seems AWL's Q1 results paint a picture of, well, a company really skillfully navigating some pretty tricky headwinds.
Yeah, I think that's fair.
They're not just reacting, they're actively consolidating strategically, like with the rice business. They're leaning into new growth areas like quick commerce, and they're putting money into future capacity and sustainability.
Right.
It feels like they're doing a complex balancing act, managing today's challenges like that revenue volume paradox we started with, while still building for long-term growth in this incredibly dynamic Indian market.
And if you connect that to the bigger picture, I mean, it just highlights how crucial adaptability and real strategic focus are in today's markets, right?
Totally.
They're clearly responding to everything, shifting consumer habits, wild commodity prices, even major government policy changes. It's actually a pretty good case study of how a large agribusiness can still find growth and efficiency, even when things are tough.
So as you think about everything we've discussed today, here's maybe a final thought to chew on. In a world where things can change so fast, market conditions shifting dramatically, what kind of agility do you need to build? Whether it's in your own business, your investments, or even just how you learn. How do you get ready to not just survive, but actually thrive when consumer behavior and market rules can change almost overnight?